in financial planning. The final period before a significant monetary event, such as the week before payday, often perceived as the most challenging. This phenomenon is frequently discussed in the context of personal budgeting and cash flow management. It is not necessarily about a lack of funds, but rather a convergence of psychological and behavioral factors that amplify the sense of financial pressure. This period highlights the relationship between income cycles and spending habits. One primary element is known as mental accounting. This is a behavioral economics concept where individuals categorize their funds into different mental accounts based on their origin or intended use. As payday approaches, the mental account for discretionary spending is often depleted. The feeling of scarcity arises not always from an empty bank account, but from an empty mental budget for non-essential items. The anticipation of replenishment can make the current constraints feel more acute. Another contributing factor is the psychological principle of the peak end rule. This rule suggests that people judge an experience largely based on how they felt at its most intense point and at its end. For a monthly budget cycle, the end is the week just before the next income deposit. If this period is characterized by tight financial constraints, the memory of the entire month can be colored by this final, difficult week, making it seem harder in retrospect than it may have been. Furthermore, there's the concept of decision fatigue. Throughout the month, an individual makes numerous financial decisions: what to buy, what to defer, how to allocate funds. By the end of the cycle, the cumulative mental effort of making these choices can lead to a state of depletion. This can result in poorer financial choices or a heightened sense of stress when faced with even minor spending decisions, as the cognitive resources to evaluate them are low. The final week simply bears the brunt of this accumulated fatigue. The timing of bill payments also plays a significant mechanical role. Many recurring expenses, such as rent, mortgage payments, and major utility bills, are structured to be due at the beginning or middle of the month. This leaves the latter part of the month to be managed with the remaining discretionary funds. If initial spending was higher than planned, the buffer for the final week becomes thinner, creating a tangible resource shortage that compounds the psychological effects. From a planning perspective, this end-of-cycle pressure often exposes misalignments in a budget. A budget is a forward-looking financial plan, but its effectiveness is tested by real-world spending. The last week serves as a real-time audit of the month's financial discipline. Any deviations from the plan, unforeseen expenses, or impulsive purchases become most apparent when resources are at their lowest point before the next income cycle begins. The anticipation of future income can also paradoxically make the present feel more constrained. This is related to temporal discounting, where a future reward, like a salary, is perceived as less valuable the further it is in the future. However, as that future reward gets closer, the contrast with the current state of scarcity can become more pronounced. The proximity of relief makes the immediate lack of it feel more frustrating. An individual knows financial flexibility is just a few days away, which can make the current inability to spend freely feel more restrictive. Additionally, social and commercial pressures do not cease at the end of a budget cycle. Invitations to social events, marketing for sales, and other spending opportunities continue to arise. The need to decline these opportunities due to budget limitations can be more frequent in the final week, leading to a feeling of missing out, which is a psychological cost. This feeling is often interpreted as financial hardship, even if basic needs are fully met. In many household financial systems, the final week is also when a reconciliation process occurs, either formally or informally. People review their accounts to see where the money went and prepare for the upcoming months. This review can bring to light spending patterns that were not consciously tracked during the month, sometimes leading to feelings of regret or anxiety about past decisions. This retrospective analysis, happening when funds are low, contributes to the perception of the week being difficult. It is a common observation in financial education that smoother consumption patterns are associated with less financial stress. The difficulty of the last week is often a symptom of lumpy spending, large expenditures followed by periods of austerity, rather than a consistent, even distribution of spending throughout the month. The human tendency is not always to smooth consumption naturally. It is a learned skill in financial management. The experience of the hardest week is therefore a complex interplay of cash flow mechanics, cognitive biases, and emotional responses to perceived scarcity. It reflects the structure of income and expenses, the mental frameworks used to manage money, and the finite nature of cognitive resources for decision-making. The perception of difficulty is tied less to absolute poverty and more to the cyclical nature of personal finance, where the end of one cycle and the anticipation of the next create a unique set of pressures. The outcomes of navigating this period can vary widely depending on individual circumstances and planning.